It is finally here. The week that I'm sure many investors have been eagerly awaiting has finally arrived. And that, of course, is the week where we see the Federal Reserve, the European Central Bank, and the Bank of England all reporting their updates on monetary policy. So in today's video, let's try and do a preview of these and see how markets have been anticipating to these events. Hello and welcome back to our channel. My name is Daniela. And as I said, today is all about central banks. It is a very, very busy week on the calendar. So we're going to be previewing specifically the European Central Bank, the Bank of England, and the Federal Reserve. But before we get into it, please like this video, comment, subscribe, turn on your notifications. And if you have any questions about trading or the markets, feel free to use the comments down below and we'll try to get back to you as quickly as possible. So as I was saying, a very big week this week on the calendar. We'll have the Federal Reserve kicking it off on Wednesday, followed by the European Central Bank and the Bank of England on Thursday. Also on Thursday, not to leave aside, we'll also have the SNB, so the Swiss National Bank, and Norges Bank, which is the Norwegian bank. But today we will be focusing on the Fed, ECB, and Bank of England. Now, markets have been anticipating this event for quite a while now. It seems like the focus in markets right now is who's going to cut first. When is this first cut going to happen? And a lot of the momentum that we've seen, especially in the FX market, has been positioning around this who's going to pull the trigger first with regards to rate cuts. Now, today there isn't that much on the calendar. On Monday, it's kind of going to be a little bit of a hit and miss day, I think. We're just going to see markets gearing up to this event, preparing themselves, trying to potentially de-risk some of their portfolios leading up to some of these volatile events that will be happening starting on Wednesday. Prior to that, though, we do have the US CPI for November out on Tuesday. That is potentially going to be a market mover. It is going to be a very interesting appointment, because, of course, that will potentially skew some of the momentum heading into the Federal Reserve meeting on Wednesday. Now, markets are anticipating for headline CPI to not have grown at all in November when it comes to month-on-month. So 0% month-on-month for headline CPI, and the year-on-year figure expected to drop marginally to 3.1% from 3.2%. Remember, we did fall to 3% in June prior to the rise that we saw in the summer. But as I was mentioning, we have seen it go up from there. So markets are now expecting it to go down almost to that 3%, which is the upper bound of that Fed range around that 2% target. So a lot of anticipation for this data. In terms of core CPI, expecting it to come in unchanged at 4%. Now, we have seen it drop steadily now for the last few months, but we did have the unemployment data on Friday. We had the latest jobs data in the US, again, for the month of November, and it did come up pretty strong. So it kind of broke that bias that markets have and that momentum that's been going on in data getting weaker as it comes out. We saw NFP actually coming in higher than expected, and the unemployment rate actually dropping unexpectedly from 3.9% to 3.7%. Hourly earnings were also up unexpected, which do highlight there are some areas in the economy that still pose a risk to prices. So we do have some hot spots with regards to domestic inflation. So that highlighted the fact that the disinflation process isn't linear. So we may see potentially a little bit of skepticism going into tomorrow as we see the CPI data come out. Now, if it does come in line with expectations, so we see a drop on the monthly and headline figures, then we could see markets gearing up towards the Federal Reserve on Wednesday, expecting to potentially see a further dovish tilt from Powell and his team. Although I am expecting that not much is going to happen at the Fed meeting. In fact, markets are as well, 99% chance of no change at the meeting on Wednesday, currently priced in markets. It is likely to be a non-eventer, but we have seen Powell in recent weeks. In fact, he had a speech not last Friday, but the one before, and he did try and convince markets that he is still pretty hawkish, but he used a lot of conditional language, and he was saying that we could potentially see another rate hike if the data deems so. Well, it seems so far that the data does not deem necessary to have another rate hike. Of course, the CPI data on Tuesday will be important to measure that. But it seems like no change from the Federal Reserve, but a lot of the momentum will come from the commentary and how markets react to that. In the past, when we saw Powell come out about 10 days ago with his attempted hawkish commentary, we did see the dollar down, yields down, gold and equities trading higher. So markets not really believing that stance and pretty much seeing it as his attempt to try and convince markets that he still doesn't believe that the Federal Reserve needs to take a dovish tilt and start cutting yet. Once markets perceive that he does have that mentality, or as soon as he comes out and says we're looking at rate cuts at some point next year, then we automatically have a deflationary. So then we automatically see markets react to that, and we could see inflation pressure coming from the back of that. So it's likely that we see Powell hold off on his stance for now. So pretty much unchanged, non-eventer for that. If we do see CPI coming in higher than expected, coupled with the jobs data that we saw on Friday also coming in higher than expected, I wouldn't be surprised if Powell takes an even stricter hawkish tone at the meeting on Wednesday and therefore drops maybe some of that conditional language and says that they are potentially looking at another rate hike, given that the data has kind of skewed away from that weakening and has now come up once again. Again, that might just be a ploy to convince markets and to kind of lay off a little bit of pressure. But of course, with the way yields have been dropping in the US, that is in itself causing a little bit of loosening in monetary policy. So he may want to avoid that further. And we may see that commentary coming in a little bit hawkish, a little bit more hawkish. So that is for the Federal Reserve on Wednesday. On Thursday, we'll have 4 central banks: ECB, BOE, SNB, and Norges Bank. With regards to pretty much all of them, we're expecting to see no change in monetary policy. With regards to Bank of England, the data has again worsened. It has started to loosen. It is showing a stagnating economy. In fact, growth in the third quarter came pretty much stagnant for the UK economy. But the jobs data continues to be a concern. We do still see wages putting upward pressure on prices. The disinflation process for the UK hasn't been quite as linear. We did see a big drop in the previous reading, but prior to that, it's been a little bit more sticky. So I wouldn't be surprised if the Bank of England continues to remain neutral. I wouldn't say they're necessarily hawkish. In fact, Governor Bailey has struggled to give that message since the beginning. But I don't really see any chance that he will start talking about rate cuts anytime soon. I think, again, this is pretty much a non-eventer with regards to what happens. The messaging from Bailey, commenting that, yes, the economy has slowed and the data is showing good progress, but that there are still very, very hot spots in the economy with regards to inflationary pressures. With the ECB, a little bit more of a flip here because we have seen inflation dropping significantly, not only in the Eurozone as a whole, but in Germany, in Spain, in France. We have seen this really significant drop in inflation. We've seen growth stagnating. In fact, we've seen negative growth, for example, in Germany in the third quarter. So it is showing a greater picture of concern. And markets are expecting the ECB to actually be, out of these 3 banks, the one that addresses this the most. In fact, looking at market expectations, I said pretty much unanimous that there will be no change at any of these meetings. But with the Federal Reserve and the Bank of England, although marginal, the remaining 2, 3, 4% of the pricing is actually geared towards a potential 25 basis point hike. Very highly unlikely, but at least the remainder of that unchanged is going towards a hike. If we're looking at the ECB, there is about a 5% chance priced in for a rate cut at this meeting. Again, highly unlikely that happens, but just the fact that that remaining 5% is no longer geared towards a hike, but to a cut, it's significant in itself to show that market positioning is a lot more dovish with regards to the ECB compared to the Bank of England or the Federal Reserve. As I said, no change expected in any of these monetary policies, but Lagarde will have a tougher time convincing markets that it isn't yet time for a rate cut. In fact, we've seen a lot of ECB members coming out recently and saying that no, it isn't time yet. There is still further pressures to deal with in the inflationary environment, But there are some members that have started to suggest that maybe it's time to start considering rate cuts. Markets are now pricing in the first rate cut to come around April, which is much sooner than the Federal Reserve or the Bank of England, which are currently priced in for the third quarter. Now, going forward, a lot of the momentum, especially in the FX market, is going to be these rate differentials. So, for example, if markets are expecting the ECB to cut before the Bank of England or the Fed, then this will put downward pressure on the euro versus the US dollar or the pound. So we'll maybe see euro dollar dip lower alongside euro sterling. If we see, for example, the Fed expected to cut before the Bank of England, then we may see cable, so pound dollar, pushing higher on the fact of that rate differentials. Right now, as I said, it's all about pricing in that first rate cut, and the currency that's expected to cut first will probably see some downside pressure heading forward, especially coming out of this meeting. Let's jump onto the chart now to quickly review how some of these pairs have been moving. Okay, so let's kick it off with the US dollar index. As you can see, recovering some momentum in recent weeks. Now, you know that most of this negative drop here has been on the back of that weakening US data, which has led markets to position themselves towards the end of rate hikes from the Federal Reserve and pricing in the start of those rate cuts. Now, we have seen that momentum turn mostly on the back because we've also seen some weakening data elsewhere. And as you know, the dollar index is composed of some of these big pairs that include the US dollar, euro dollar being one of them. And with data worsening in the euro zone as well, we've also seen weakness in the euro, allowing the US dollar index. But also, as I was mentioning, that stronger jobs data, as you can see here on Friday, bringing the dollar index higher, strengthening that push towards the US dollar. Also, as yields have also been reversing slightly some of the weakness, we've also seen this move higher. So the US dollar has been picking up momentum. And of course, that essentially means that pairs like euro dollar have been heading lower. As I was mentioning, we've seen weakening CPI across most of the economies in the Eurozone. That has been weighing on the euro. That allows equities to push higher. So, for example, the likes of the DAX and Euro stocks, IBEX 35, the Spanish index have all been consistently moving higher and breaking key levels. The IBEX above pre-COVID highs, the DAX breaking to a new all-time high. It has actually weighed on the euro because of what I've been saying. It positions markets for a earlier or sooner rate cut from the ECB as compared to, for example, the Federal Reserve. So that has been weighing on the euro. It's been trying to stabilize over the last few trading sessions here, just finding some support along that 100-day simple moving average at 107.59. The RSI has now dipped below the 50 line, so it is suggesting that the short-term bias has now started to shift to the downside, potentially the path of least resistance continuing lower. As I expect no volatility in today's session, markets just gearing up to that. We may see some moves tomorrow on the back of that CPI data. And of course, on Wednesday and Thursday, depending on how markets react to the commentary from the two key central banks in this pair. If we are looking for some upside momentum, there will be some resistance along that 200-day simple moving average here, that yellow line at 108.23. Other than that, it does seem to be like a straight path higher towards 109. That is, of course, if we do see euro coming out with more bullish momentum than the US dollar. Now, with regards to the pound, a little bit trickier here because the pound hasn't been as weak as the euro. So as you can see in this downward trend, we are seeing some attempts to push higher, struggling to see those buyers coming in. So far today, we are looking to break higher once again. But there is quite a lot of support for this pair, I believe. As I said, I think the Bank of England will not be as easily convinced to give in to these demands about rate cuts and being more dovish. So I think the cable will have a little bit more momentum to recover here. Again, the data tomorrow, the CPI, is going to heavily impact the US dollar. So we'll likely see this pair move. If it comes in stronger than expected, we may see the US dollar pushing higher, therefore weighing on cable. Alternatively, if the CPI comes in lower than expected, we could see this pair pushing higher once again, heading to look to break above 126 once again, and looking to hold above that area to be able to capitalize on any further moves back towards 127 here and to the highs that we saw at the end of November, where we saw some increased resistance just along that 61.8 Fibonacci at 127.20. That is it for today's preview on the upcoming central bank meetings. Thank you so much for watching, and don't forget to subscribe to our channel.